Hello, in this video we are going to talk about Moody's KMV EDF. This is one of the most spectacular models in credit risk. It shows how the very simple stylized model of Merton can be modified to fit reality, so applied to real firms, and output probabilities of default that work very well. So this was developed by a firm called KMV, and the model became so successful that it was later acquired by Moody's, and now it's KMV. It's part of Moody's Analytics. So Moody's is in this interesting business, so that they sell credit ratings, and at the same time they also sell this output of KMV, which is essentially a probability of default. And this probability of default has actually become the gold standard in probabilities of default. So it has been a really successful product, a really good example of theory applied to reality. So KMV stands for the names of three people. The last one, Vazicek, it's this guy here, Vazicek, which is also a very important guy in finance. He has made a lot of important contributions in term structure models and so on. All right, let's go to the model. So the idea is the following. We're going to, in the end, get a probability of default, which they call expected default frequency, but it is just a probability of default. And to get there, we're going to do this in 3 steps. So first we're going to estimate the asset's value and volatility. Then we're going to calculate a new measure called distance to default. And then we're going to map that distance to default to the final outcome that we want, which is the probability of default. Okay, let's start with number 1. So first, estimation of the assets process. So we are in the context of Merton's model. And as you recall, the asset is the main driver in Merton's model. But we actually cannot observe the value of the assets. That may sound funny at the beginning, because you might think that, well, to observe the value of the assets, and by value I mean the market value, I could just look at the right-hand side of the balance sheet and add up the market values of the right-hand side. So if the firm is traded, the equities part is okay. I can just look up if the stock is traded on an exchange, there is a price. I can multiply the price by the number of shares outstanding, and I have the total market cap. So the equity part is fine. But then we also have debt. In the debt side, we can have bonds. If those are traded, I can still get a good approximation for the market value of that. But then every firm has bank loans that are not traded, and those I cannot observe a market price. They can also have debt to their suppliers and so on. So there is a bunch of items on the debt side, on the liability side, that are not traded, and therefore I cannot add up the right-hand side of the balance sheet and estimate the left-hand side. So I have to get at the market value of assets through some other procedure. So this is where KMV was really ingenious. So we have 2 variables that we have to find out, to estimate. One is the value of the assets today, V0, and the other is the volatility of the assets, which in the previous chapter on Merton model we call just sigma, but here, to make clear that this is for the assets, we call sigma V, to say that it is the volatility of the assets, of the asset process. So we have 2 unknowns. We have to get 2 equations to find these 2 unknowns. The first equation is coming directly from the Black-Scholes model. So as we have seen before, in that Merton model, we can think of equity as a call option on the value of the assets. So this equation that you have here is the equation we derived before in Merton's model. The unknowns are the value of the assets here, and recall that D1 and D2 are themselves functions of V0 and sigma V. So this is a nonlinear equation. So we have one equation. The second equation is this one here. What this does is it relates the volatility of the stock price to the variables that we want, the volatility of the assets, and sorry, the value of the assets and the volatility of the assets. And again, these two variables are also inside U1. So again, this is a nonlinear equation. The volatility of equity we can estimate using a time series of stock returns. So this is easy to estimate. And given that estimate, we can find these two variables that we are interested in, V and sigma. So together with this first equation, we have two equations in two unknowns. Okay. The derivation of this second equation is a little bit more complicated. You can see it here in the footnote, but this derivation here is outside the scope of this course. So we're just going to take this equation as given. Okay. So this is the main intuition for what they do. Two equations to find these two unknowns. In reality, today, what they do is something a bit more sophisticated, because in reality, firms do not have a capital structure that is as simple as the Merton model suggests. So instead of these two equations, we have or KMV uses two other equations that are more complicated. We do not know the details of what they do, so this model is proprietary. They charge their clients for their output, so they don't give us the full details of what goes on in their computers, but it will be something that looks more or less like this, adapted to a more realistic capital structure. All right. Actually, we have a third parameter to estimate. Recall that in the process of the assets, we also have a drift, a mu, and that we also have to come up with a value for that. Unfortunately, means are very hard to estimate, so there is not a very good solution to get this mu. There are some alternatives that we can use. Again, it is not very, the model is not very transparent. We don't know exactly what KMV does, but you can read here some possible alternatives. All right, so we have the first step here. We have the value that we have estimated the process for the assets. So now let's go to step 2, estimate the distance to default. All right, so the main idea is the following. In Merton, a firm would default whenever the value of the assets was below the face value of debt. In practice, we observe that it is not that simple. I mean, firms do not default immediately as soon as the value of the assets falls below debt. They are able to hang on for some time. So what KMV does is define a default point, which we call here D star, which is the short-term debt plus a fraction of the long-term debt. And the idea is that the long-term debt is not due immediately, so the firm will not default as soon as the value of the assets falls below the full long-term debt, because not all the long-term debt has to be paid right now. Why 1/2 instead of some other fraction? Again, we don't know. It's probably the case that KMV experimented with different levels, and this one worked well. Okay, so given this critical point, what they do is they define a distance to default, which is, as the name suggests, the distance between the current value of the assets and that default point. Right? So the larger this distance, the safer the firm is. And as this distance becomes smaller and smaller and smaller, it means that the value of the assets is becoming close to this critical default point. And when it reaches, presumably the firm will go to default. It's divided by this sigma v0 just to standardize the difference and to make this more comparable across firms. Okay. So this is the basic distance to default, in the sense that this is the more intuitive version. It's actually the first one that the first version of the model used this one. What KMV does nowadays, it's slightly different. And this is actually, it's easier to see this with a figure. So let me open this figure here. So again, we have three steps. We have done the first step. We have an estimate for the value of the assets and the volatility of the assets. Now we are in the second step. We have this critical default point. And intuitively, this is what's going on. So again, this is the figure that shows the value of the assets evolving through time. It starts here today, and it will evolve through time. The initial distance to default was essentially this distance here between what the firm is worth today and the default point. What we want to do usually, it's not to measure what is the probability that the firm will default right now. What we want to do is to measure the probability that the firm will default over some horizon, say 1 year. So we are not interested in comparing the value of the assets with the distance to with the default point right now, but we want to compare the value that we expect the assets to have at some point in the future with that default point. So the current distance to default is essentially this distance here between where we expect the assets to be and the default point. So in the handouts you have more precise the exact formula for this distance to default, but intuitively that's the difference. That's the difference between the current version and the old version. Okay, so that's step number 2. We have a distance to default, and then the third step is to map that distance to default to a probability of default. So if we step back, what Merton would say, in Merton's model, the probability of default, if you recall, is this area here of this tail, right? Which you can show that it is the value under the normal standard distribution to the left of the distance to default, okay? What people observe is that in reality, the number that you get from this normal distribution does not fit reality. It's too low. So instead of using this number, what KMV does is to map this distance to default to a probability of default, which is not exactly this tail here. It's some other empirical number, which they call EDF, expected default frequency. Again, this is a probability of default, just with a different name. The point here is that we, again, do not know how they do this mapping. They use some proprietary database that they have of firms that have defaulted through time. And without that database, we cannot do this last step of going from the distance to default to an actual probability of default. So going back to the handouts. This is where we were. Let's look at an example of real EDFs published by KMV. So this is one of their examples that they publish several examples showing how their model works. This is for Federal Express on 2 different dates, November, and then a couple of months, 3 months later. So we can see here that in the beginning, this is the market cap. These are the book liabilities, so these 2 numbers are observable. Then these numbers have to be estimated using that process we described before. So we estimate this value of the assets and this volatility of the assets. We can also compute the default point using the expression we had before, the short-term debt plus half of the long-term debt. And then the distance to default is the distance between the assets and that critical default point, standardized by sigma v0. Okay, that would be 4.9. Using their database, they assign to a firm that has a distance to default of 4.9, they assign a probability of default of 0.06%. Okay, so 3 months later, what happens? The market cap is lower, from 7.7 to 7.3. Liabilities are going up from 4.7 to 4.9. So this is already signaling that something is wrong, right? The stock price is going down, debt is going up. It's not a good sign. These are the values that they estimate for the value of the assets, lower from 12.6 to 12.2. The volatility is going up from 15 to 17. The default point it's a bit higher right now, 3.5. So if you go through the distance, the calculations, the distance to default is becoming lower, right? This is bad, because it means that you are closer to default. So from 4.9 to 4.2, you're evolving in the bad direction, and the EDF is signaling that the probability of default is now higher, so the firm is more likely to default than it was 3 months ago. Okay, so this summarizes the differences between this new model and the original Mertens model. And now let's compare the EDF to their competitors, which are the agency ratings. Okay, so this whole model, this KMV model, was developed with the motivation that agency ratings were not accurate enough to warn investors about defaults. And to show their case, KMV published some examples that illustrate in a very stark way the advantage of their measure. So this example here in particular, it's the example of Enron. If you have not heard about this company yet, I definitely recommend that you read about it. There are at least 2 books telling the story. This was a big firm in the energy business in California, and for some years this was a very successful firm. It totally dominated the market, and all of a sudden it imploded in a huge bankruptcy, because people realized that a lot of things that they were doing was just fraud. So what you have here in this figure is the date of default here at the end of the scale, December 2001, and then here this is about 1 year before that. So what you observe, the red line is the rating, the S&P rating, and it's flat until October, so a couple of months before default, and then it rises very quickly to default, right? So the point here is that investors were not warned about the problems at the firm during all this period, and only almost at the event did the rating start to change. In contrast, what you have here is the EDF, and the EDF starts rising 1 year before the event. So it goes up, and it steadily shows that there is something going on, some problem going on at the firm. So the EDF is actually kept at 20%, so it reached the maximum level here. So the point that EDF shows with this is that if you want a measure that warns investors in advance, giving them time to take action, you need something like the EDF. Okay. So I mean, this is something very impressive, right? So now we have to ask, well, where is the advantage coming from, right? Why is it that this firm, not this firm, why is it that the EDF is so good in capturing the problems at Enron so early in advance, whereas the credit rating agency was basically flat? So the answer is that the advantage comes from the stock market, right? The main source of information that gives you this good performance is the fact that when you are estimating the value of the assets and the volatility of the assets, you are using information from the stock market. You're using the stock price, you're using the volatility of the stock price, and that's the nice thing about the stock market, is that it is an aggregator of all the information of different investors. So people that knew about the problems in Enron were trading on the stock market, and that gave information to this probability of default. All right, there is here an alternative estimation procedure. We're not going to go through this. This is an interesting note here, a bit of a side note. People have tried to get cheaper alternatives to the distance to default. So something that you can compute without having to go through all the mess of those complicated equations that KMV estimates. So in particular, this paper here came up with this very simple alternative, in the sense that this is only using information that is easy to estimate. It looks a bit of ad hoc kind of formulation, but the point is that it works. Namely, if you just compute this simple measure here, you are able to come up with something that is reasonably good. Okay, so for example, if you go back to this example that we had used before, you have here some numbers that I estimated at the same time as the previous figure. So you have the return on the stock and the volatility of the stock. So using the information that we had before plus this, plugging in here, you can compute a probability of default using these formulas here that amounts to 10.58%. Okay, so the question is whether this probability of default makes sense. So go back to that exercise we did in a previous chapter and think whether this 10.58% of the probability of default is consistent with the z-score that we had up there and with the rating that we had up there. Okay, we can discuss this further in class. You will find that the value is reasonably consistent. Okay, it's not totally precise, but it's in the right ballpark. So the point here is the following. This measure gives you a good relative ranking of firms. It does not give you a precise probability of default. So, I mean, it's not a full replacement to KMV's EDF, but it's a good variable that you can use in other models like the logit model we talked before, and get a cheap version of the EDF that at least allows you to distinguish between more risky and less risky firms. All right, that's it.